Oh, a warm welcome to everybody to the next part of our webinar series about developing superb trading strategies. This kind of webinar series is offered by Argus-FX, the broker of choice here, and it's a pleasure for me to work with Argus-FX together and in order to have those kind of webinars for you. Yeah, it has been, I think, 2 or 3 weeks now. Pause here for that webinar due to simply holiday from my end. So I have been to the United States for a little bit more than 1 week. I'm safely back, as you can realize, and I still have not answered every question which reached me during my travel, so be sure that I will get in touch with you as soon as possible. There have been some things to be done first during the last couple of days, but of course every question gets an answer as usual. My name, by the way, I have not mentioned, Stefan Friedrichowski as always, and today we have the 8th of December 2016, 11 o'clock. Yeah, that's the usual time, and it's a pleasure for me to have you once again here. So topics for today. Yeah, of course, not really question answers, but I will comment a little bit on what's going on in the CFD market and broker market. There are a few things which happened during the last couple of days, and I think it's important to talk about that as well, because yeah, that definitely needs a comment from my end. And I will do it. Then we dig into the topic we have had in the previous webinars, and that is pair trading strategy. We have been already for Brent WTI for the two sorts of oil with a good strategy, and of course this needs a follow-up. And yeah, we'll do a short recap on what we have done and achieved up to now, but we will go further. And going further means here that we will try to adapt the pair trading strategy to another pair. And in this case, it will be the S&P 500 and Dow Jones. And let's see what we can achieve there. But even there, we should not stop, because our basic concept is already able to completely change our view to another kind of strategy, which is already in the Excel sheet we have developed. And that is that we can adapt the basic idea to a single underlying. So it's then not anymore pair trading. But you will see we can use the same kind of a concept for a single underlying, and I will do it for an example here with S&P 500, but that can be done with every other single underlying as well. You will see that it's only that we need a small change in our Excel sheet, and we have basically a complete new strategy. We would name it different. Of course, it's not anymore pair trading. It's a single underlying, so it's a normal strategy. And you will see it's a kind of mean reversion strategy, which is quite interesting, that the concept we developed for a pair can automatically be adapted to a single underlying and will transform into a strategy which normally would be called a mean reversion strategy. So trade into the direction of the overall or trade the axis. So let's see, you will understand later much more better. As I always, here's a comment, 2 comments. One, you can find the previous webinars on my YouTube channel. So you need this one here. If you don't either you do screenshot or you just send me an email at friedrichowski@argusfx.com. And the other comment as well, because we are talking about trading and trading strategies, let me always give you the risk warning, which is here on my slide as well. But I know everybody of you knows that the trading with CFD is risky, and that you do everything on your own. Before I really start, I would like to mention another webinar series which will start in next week on Tuesday. So what we have here is that we on next Tuesday we have an additional webinar series. Once again, it's in English, and then it's 2 p.m. MEZ time zone, or 3 p.m. EET. And that is simply to learn the basics about trading. So basics really means I want to start with MT4, how to enter trades. I want to show you how to manage the overall MT4, to manage profiles, to manage the charts, and finally to manage the trades. I want to talk about risk management. I want to talk about some basic strategies. So really, from the very starting point of trading, I would like to introduce you into the world of CFDs and trading with CFDs. So that's really a starting, a beginner's webinar. Maybe it's something for you as well, or maybe you know somebody who might be interested in that kind of webinar. Then just send him a note. And for all of you, I sent the link. It's already on the website of ArgusFX, and let me share the link with you. And I simply take a good morning question here. Oh, once again, just a second. So now I get it right here, and then you have the link as well for those webinars, and you can register here either or both for the English one as well as for the German one. So it's meant for the really basics of trading, and maybe it's of interest for you as well. But now back to our current webinar. And I mentioned not to answer any questions right now from last week or last weeks. In this case, I just want to comment a little bit on what is going on in the CFD market. There are basically two news, so to say, not news in the sense of unemployment rate in United States or something like that, or in a couple of hours we will have the EZB interest rate decision. No, there are two news from the financial authorities, and one is from the so-called SAISEC, that is the Financial Authority of Cyprus, which is corresponding in Germany to the so-called BaFin, or the other one who made a comment over the last couple of days, that was the FCA, that is the Financial Authority from the United Kingdom. And yeah, both have will have a huge impact on the CFD market. And yeah, the first one pops up from CyTech, so the Cyprus Financial Authority, and they mentioned, well, they have announced that all accounts should have a limited leverage of your account, and that a limit should be 1 to 50. And they will forbid any bonus programs brokers might offer. And so that is one reaction, and the other one stems from the FCA. It's quite similar to the one of Cyprus. It goes even a little bit more. So they want that the leverage for beginners should start with 1 to 25, for the first 12 months. I have no idea how this should be implemented directly, but anyhow. And after that, you can change your account to 1 to 50 as well. Even FCA want to forbid any bonus programs. And additionally, which is quite interesting, they want the brokers to publish the average trading results of all clients of that broker. That is really something quite interesting, and they have done, I don't know how they got the number, but they got a number of 82% of all clients lose money. I know another number like 95%, but they want the brokers to publish those results. I have no idea on what time base, but anyhow, it's interesting that they do something like that. So my principal comment on that is, before I comment, so the first one, CySec, is already announced, and the brokers have time until the 30th of January to implement next year. And in United Kingdom, up to now, there's only a letter to all brokers in the United Kingdom. They requested to comment, and finally in spring 2017, they want to set up the final rules. Yeah, my comment on that is quite simple. I like it, to be honest, because why not? To don't have those excess boni programs, because I always question that kind of programs, because there's only always one who can pay the bill, and the bill is paid by the customer and nobody else. So I don't like those kind of boni programs, and to set up a limit for the leverage, so why not? It's for the sake of everybody, and yeah, you can question in general, should the state protect people from themselves, but anyhow, it seems like they will do it, and I think it will be a good step for the brokerage market in general. But anyhow, so that's for that topic. It's interesting to see the next reaction of the German BaFin, and maybe other countries will follow, like Austria. Let's see. But now back to our pair trading strategy we have developed already and we started with Brent and WTI. Let me summarize and recap a little bit on that strategy, because it's a little bit time since we have had the last webinar. So in principle, we started with a quotient, or let's say a ratio, of two correlated underlyings. And the reason for that, and I mentioned already that for me the best example for correlated underlyings is always Brent versus WTI, because we have two sorts of oil, and in principle those two oil prices cannot the price can differ. Maybe there's some physical reason behind that, but for a long period of time, the prices cannot diverge very much, because if the prices of the two would diverge, then the industry would react and change the one against the other. So for that pair, we have definitely a very well prepared story behind that. Those two prices cannot diverge for a long time. So they have to come back. If one price goes up and the other price goes down, then there must be a change over time, and the two prices must, in brackets, come together once again. So that is the concept of pair trading. But how did we implement? We implement the strategy in a way that we look for an excess. No, I think it's a better pronunciation, because we don't want to enter we look for something which is not out of control, but there's something which is really extraordinary, so to say. And whenever we realize that excess of the ratio, then we want to enter a trade, and we enter always two trades, one short and one long trade. So in case the Brent price goes up and up and up, and WTI would go down, 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 then we would open a short on Brent and a long on WTI, because the ratio should come together once again. And that's the basic idea of this pair trading strategy. Such a trade is closed. Well, let's start a little bit earlier. So we calculate the ratio, the quotient of the two prices, and then we put an EMA on that ratio as well. So that is to smooth a little bit that ratio. And what we now look is, whenever we have a huge distance, a price difference, or a difference between the ratio itself and the EMA on that ratio, that is a signal to open that pair trade. And we close the trade when when the actual ratio crosses the EMA on that ratio. That is a signal to close that kind of trade. In principle, those trades are running without any stop loss, which is in principle quite risky. And we have seen what that means in the history. And we know that this has an additional high risk. So that is important to mention. We saw for some examples that our temporary loss can be huge, but finally, not in all cases, trades are, the pair trade itself comes to a positive end. But we have to keep in mind that there is an additional risk compared to other kind of trading strategies where we have a fixed stop loss. But even then, we know that a fixed stop loss does not really protect us, at least not over weekends or in times where the corresponding market is closed. We have set up a scheme for calculations of position size of those both trades for the pair trade, and we have done it already quite universal, so that we are prepared to for any other kind of pairs. That needs some consideration. You have always to keep in mind, hey, what is my minimum lot size? What is the step of my lots I can do, and so on. So everything is already incorporated into the Excel sheet, and when I go further and change everything to S&P 500 and Dow Jones, then you will once again see what kind of changes have to be done if one changes the pair. Let's look once again to the results we have had already. And in order to recap a little bit more about the basics of the strategy, you might remember that first we calculated the ratio, and we calculated the EMA on that ratio as well. And that, for example, gives us a chart like the one here, where we have the ratio and the EMA within that ratio. In order to see a little bit more how that works, I have zoomed for the last couple of months here in the next picture, and then you can see that the red line is the EMA on the ratio, and the blue line is the ratio, the actual ratio. And then you see from time to time, then we have spikes in the actual ratio compared to the EMA on that ratio. And those spikes should be the entry signals for our trading activities. So finally, that means what we are doing is we calculate the mathematical, simply the difference between the actual ratio and the EMA on that ratio, and that would bring us to the following picture here. And since once again one cannot see over 14 years the details, I zoomed in a little bit here for the last couple of months. And then you can already directly see how this trading strategy is actually running. So here is now the difference between the actual ratio and the EMA on that ratio. And whenever we have those axes here, that would be the starting point for a trade. And this one should go here down, and whenever we cross once again the zero line, so that means that's the difference between the ratio and the EMA on that ratio crosses the zero, that is a stop signal for our trade, or the exit signal for any trade. So this has been done within the Excel sheet, and that is the base of the strategy. And we have here two kind of parameters we can change, and one parameter is the EMA period for the EMA on that ratio. And then in order to have a limit when to start such a trade, we use a nice calculation, in the sense that we look what is the typical deviation between actual ratio and EMA on that ratio. That is calculated here. So what is that typical difference? And then we use simply a multiplier on that. And right now it's 1, but it might be 1.2, 1.3, or whatever. And then this is a starting point for any pair trade. So we started with doing everything on a percentage scale, and then finally we put in the spreads for both the both underlyings. In this case, it's the same one, 0.03 for WTI and Brent. And what we have done as well is we have done everything that we can really translate our trades into lot sizes, and that we know, okay, we want to apply simple rules like later a pair trade of with which finally would represent a change of 1%, that should equal a specific value in money. And in my case here, I set this 1% change of a pair trade should be $50. And that is the one number we have to take into account. And the other number to be taken into account is what is the price equivalent of a $1 change in the oil price? What does it mean for the CFD? And in this case, and for the broker Argus FX, it would be a $1 change traded with one lot would result in a $100 change in your trading account. And we have done something like what is the minimum lot size, and we applied rules how on what step we can go with our lot sizes. Is it 0.1? Is it one lot? Is it 0.01, which would be typical for any Forex? So everything is here, and we get finally such an equity line. So this is quite interesting, and we know already that we have here a quite good strategy, and we know that even changing those parameters, we have still the two open parameters like the EMA value and the multiplier for the the entry criterion, that we have those two numbers we can change. It changes the results, of course. Let me do it here. If I go from 1 to 1.1, the equity is a little bit different, but still quite similar. Same is true for changing the EMA, but what we have seen already, whatever we do, it's not directly really worse. So that's our starting point. And now I will show you really in numbers and doing it here live within Excel, how to have this Excel sheet now transferred to another pair. And let me first start here with the values. And for example, I have here downloaded from Yahoo the S&P 500 data. That is one part which we have to consider. And then we have another part. Let me simply do the naming here right. It should be like this. And no, sorry, that's wrong. Naming is right, but we don't need those numbers here, like adjusted close, because that is already here in this case the real number. And we need the other one as well. That is in my case Dow Jones, and I took same data from same provider. So in this case Yahoo Finance, and we have here the same issue with volume and anything else. And the first step to be done is that we compare, do we have in both cases the same dates of everything. So what I do now is I simply copy the one in the other, and what I want to look is whether we have always the same date in every column. That's quite important, and you will see if you download from whatever platform some data, there might be days missing. So the first check when you do downloading data and prepare them for pair trading is to have a look, is everything here in the same date? So I simply check it by subtracting here those dates and see whether here is always a 0. So I now mark all the things and I see here the sum is 0. Perfect. So we don't have any missing date, and the two downloaded histories of those two prices are, let's call it, identical in terms of date. That's the first step. And the next step in this case, because the source is Yahoo Finance, then always they are vice versa in terms of date. So we have to resort the data just the other way around. So let's sort them against this one here, and then we have everything in our standard sequence. So date goes upwards when we go downwards in the columns here. So that is the first preparation. So make sure that you have the same dates and that there's nothing missing. Otherwise, you have to manually delete some lines and prepare that everything is right. And then we can take the two, and let's start with the S&P 500. And let me cross-check what I do here on another screen. So I have prepared that. And now I put those data here into that. But before doing, I give it a new name in order to not overwrite the one I have already finalized. So just a second for doing that. And let's call it simply test, because I have already prepared everything. So finally I have everything ready, but I don't want to overwrite what I have done for WTI and Brent. So now I can put in my data here into the Excel sheet. And let's start with the S&P 500. So I can simply copy the data here. And so this is now S&P 500. And then we have other data here for the Dow Jones. And let's have a look here as well. So we can take those data from that sheet and put them into the pair trading Excel sheet as well. So now we have the data here for the Dow Jones. And since we have cross-checked already that everything is the same date, I don't need a date for the Dow Jones data. So here is now the Dow Jones. Yeah, first thing what happened here, the ratio is now completely at a different level. Therefore, the picture is not anymore right. Let me simply rescale the picture. Then we will see the ratio of those two underlyings. And now here we are. So you can see the typical value, the factor between the two is in the order of 8 to 10, which calculates here to 0.1 to 0.12. In that range is the typical ratio of S&P 500 and Dow Jones. So same concept, same story. Let me first check when I go down the table. Oh, there are some more data compared to our previous one. So we have to put here some additional data. So that means we have to go down here as well. And same applies here for other data. And then we can simply copy all those rows down to the end. So that's only because we have some more data for S&P 500 and Dow Jones compared to Brent WTI. I will now not change the pictures because they go a little bit further, but it doesn't change the overall picture here. And by the way, that is nearly everything we have to do. First step, put the new data into the sheet. Second step, check the spread values. The spread values are not any longer right. A typical spread for S&P 500 might be 0.6, and typical spread for Dow Jones is something like 2 points. And of course, we would have to change everything here as well, but let me shortcut this a little bit. So if you have still here in some charts naming like WTI and Brent, don't worry, they are not right anymore, but it's now S&P 500 and Dow Jones. But anyhow, so let's not focus too much on the details of naming. I do not want to put too much time into that. But of course, what we have to do is we have to think about what is the minimum lot size and what is the value of a point for those two underlyings. And since I take the numbers from Argus in this case, the minimum lot size is simply 1 for both, and the value of 1 point, so the point value, in this case, 1 point of the underlying equals $1 $1 in the change of your account. So if you would trade one lot S&P 500 and the S&P 500 would change by 1 point, then your account would change by $1. And that's not even all. There's still something to be done, because you see, minimum lot size here in this case is 1, but we cannot adjust everything to something like 3.57 lots. That cannot be done, at least not at Argus FX. Everything has to be an integer number here, and that can be done in the Excel sheet simply by manipulating a little bit here. Then everything is rounded right, and the same has to be done for the other one that are all trades on Dow Jones as well. So let's change it here as well. And then we are nearly done with our preparation for Dow Jones and S&P 500. Nearly done. Why nearly? You see, it's always not a good idea if we have values here in the range of minimum lot size, because then we do not really trade correctly the ratio. We would need here something like 1 to 10 in the lot sizes. So this can be achieved if we increase our risk or the translation between the 1% change of our account. So when we have a pair trade with a 1% change, how much dollar should be the equivalent of that? And that is the number here. 1% now should equal 500, for example. And then you can see this one here matches much better already. And even maybe we should increase it once again, at least by a factor of 2. And then we are done. Then we can see that the calculation of the ratio is better fitted now. So the numbers are okay. The only thing, you will realize it already, I think, since 10 minutes, since I have started to put all the data of S&P 500, our equity line goes south. So you see here, trades go down finally to minus $35,000. And what we can see here is always, as introduced in the previous webinars, that we calculate the so-called floating results. So of a single trade, what current result do we have in that kind of trade? And we have situations with 5,000 euros into the minus. Okay, but anyhow, what we see, the equity goes south. And now the question is, of course, hey, is that maybe only our parameters here? Do we have to take different kind of EMAs, and the entry multiplier maybe should be different as well? So let's change a little bit here the EMA values and the entry criterion for any trade. And let's simply look to the chart we have here in the middle of my screen. You might remember we have in the middle, the yellow line is the sum of both trades, the trade on the one underlying and on the other underlying. One is in blue and the other one is in red. And now we can change, for example, the EMA value. Oops, not that way. Maybe only, let's start with 6. And I personally focus here only on the yellow line. I don't care that one goes always up, the other one goes down. Finally, what counts is the sum of both. And so, therefore, just changing the EMA value, you see already it does not bring that much. Now the picture changes dramatically, less trades. Let's move forward with the EMA value. And what I typically do, if I have no clue what might be the right number, I do everything in a more logarithmic scale. So if you, for example, would start here with an EMA of 2, then I simply go to 4, 8, 16, and so on. And I always keep one parameter first constant, and the other one here is the multiplier for the entry criterion, and this is still constant at 1. And you see now at least we have a slightly positive result here. Let's go on with the EMA value, and it doesn't really change my picture here. So yeah, you see, and let's one step additionally. Now we have nearly no trades, but still we have a negative result. And now going back here, for example, to 16, because that was not that bad. And then I try the other one, the other parameter, for example, 0.5, 0.7, 0.9, and so on. And then, for example, here I have in a positive result, but still it's not that good. So believe me, I tried a lot of parameters here for the ratio of S&P 500 and Dow Jones, and I did not find anything good. Also that I want to share with you. I know we want to try to develop superb strategies, but having results which are not successful should be shared as well. So don't blame me, and you see already that I laugh, that I show you something which doesn't work, but it's interesting that it doesn't work. By the way, one of the reasons is a spread. You can change the spread just for a second. You do it and go to 0. Then you see, okay, strategy is a lot better, a little bit better if I go to spread value 0. But we don't have them. So I change back to the spread values as they are. But I do sometimes calculations with spread 0 only to see whether it's the strategy itself or it's the trading conditions on the strategy. And in this case, it's only it's a strategy itself. It's not only the spread. Lowering the spread values improve my strategy, but not change the overall picture. So it's a strategy itself, which simply does not work on those two underlyings. Maybe there are some combinations of EMA and multiplier which show a little bit better results just by trying here different numbers, but I don't believe that we have a robust solution for that kind of strategy. Do I have a real explanation? Yeah, a little bit, and a little bit simply because personally, I don't think that S&P 500 and Dow Jones is a good example for pair trading. The one S&P 500, as the name already tells you, is 500 companies out of the US market, and Dow Jones is 30 companies out of the Dow Jones market. But maybe there are a few companies developing extremely well within the Dow Jones. And if those companies are not part of S&P 500 or on the other hand, because there are 500 companies, so a few companies would have not the same weight. Why should it not be possible that one goes up, 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 the Dow Jones, for example, and S&P 500 goes down, 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 and not coming together like Brent WTI. So we don't have the same kind of story here, and we don't found good results for that pair. Okay, so we have to live with that kind of result. Does it mean that if you try S&P 500 versus DAX, maybe it works, maybe not? Honestly, I have not tried up to now. I will, but I have not done. If you do it, be careful. You need, if you want to trade to indices, here in this case, you need numbers which correspond in time. Since we do all our trades here on close values, it's around 10 o'clock p.m. German time. So in this case, the combination should be FDAX versus S&P 500, or you have really DAX values which with a close time of 10 p.m. So you have to be careful that your close time really matches. You have always a close value for your candle, but since you have to open at that point in time your trades and we close them at the same time as well, so you have to make sure that the both close times of your close values of a candle are the same. If you have, for example, 24-hour numbers, then it's no problem, because then it's always midnight. But you cannot do Xetra DAX compared to S&P 500 with the data as we have them here right now. You can do it, but then you need close values of the S&P 500 at 5:30 German time, because that would correspond to the German DAX. So keep that in mind, that those times of the closing, they must be equal. So after this disappointing experience, but still we have a very good result on Brent WTI, so don't forget that. I already said that there's another possibility. And the other possibility, let me go here to this slide. Let me start with a question. What if we replace one underlying in this Excel sheet simply by 1? So by a constant number, and this number is 1. I will do it later, and I will take all the Dow Jones values out and replace all Dow Jones values with a 1. Think a little bit of what now happens. So when we calculate the ratio, okay, we divide always by 1. So always with the same number. So that's, we get back the same like before. So if we have in the first column the S&P 500 and we divide that by 1, then it's still the S&P 500 values. So nothing has changed. But still we can have an EMA on that. Originally we called it the EMA on the ratio. Now it's the EMA on the underlying itself. So that has a meaning, as every EMA in a chart has a meaning. And still, if we now do the difference between the actual value of the underlying and the EMA on the underlying, that difference makes sense. because it tells you how far away is the current price from an EMA on that price. That's interesting. If that number is high, then we once again have something like what I call this excess. Because there must be something, let's look into the direction, into the upwards direction. We have an EMA, and then suddenly we have a candle, a huge candle to the north. And the idea now is it maybe a good strategy if we have that excess once again to trade into the direction of the EMA, so that the price goes back to the mean. And mean in this case means the EMA value. And you might have heard already before that there exist a couple of strategies which are called mean reversion strategies. And the basic idea behind all those kind of strategies is quite simple. You call something like the fair price of whatever, euro, US dollar, S&P 500, of a stock value. Think that you have something like the real fair price of an underlying. Then whenever the current price is far away from that fair price, the price should go back to the fair price. And that is mean reversion strategy. The only question here, or there are still two main questions. One is how to define a fair price for whatever. And second question, how to define what is an excess. So what is extraordinary in that sense. But you realize already it's the same kind of question we have been done for our pair trading as well. And now I simply call the EMA on the price being the fair price. And we can, of course, change the EMA period. And once again, we have that multiplier on the standard deviation of the difference between price and EMA. And then we have an entry criterion. What do we call an excess? So it's simply the same story. All we have to do is we have to replace one of our pairs by a constant number. Let's do it. Let's go to our Excel sheet here and replace all the Dow Jones values with a 1. And even they are not taking into account, I do it for minimum, maximum, high, low, close, open, and so on and so on. So of course we have we have still the calculation of a ratio. The ratio is now once again it's always the S&P 500 itself, because we divide by 1. But we can apply an EMA on that value, of course, and we can get the same kind of pictures as before. So that means now we have here in our chart the S&P 500 itself and the EMA. I go back to down to the pictures here just to illustrate what we are doing. And I have to change here this. And now we have a zoom into the last couple of months here, and you see, okay, we have an EMA. Sometimes, for example, here we have that huge step away from that EMA. This should be an entry, in this case for a long trade of S&P 500, back to normal. so to speak. And we do the same as before, that we have the difference between the price itself and the EMA. And once again here, such a zoom. And you see that spike here, and that spike would be an entry for a long trade in S&P 500. Okay, that's up to now. And you see already, okay, my equity line doesn't look that good. But let me change here a little bit, because in the Excel sheet, still there's one underlying being traded, and the Dow Jones, which is constant at 1, is still being traded here. And of course, now here I have to enter a spread value of 0 because there is no real trade. I mean, practically, you don't trade the constant 1. So we only trade the S&P 500. Changing the spread value to 0, which is correct here. And I don't want to change the Excel sheet. So in principle, within the Excel sheet, the one is still traded, but all the trade results are 0. Now, what you see here is our equity line. Wow, doesn't look that bad. I mean, I have not changed my numbers up to now of EMA and the entry multiplier. So still we have 2 parameters we can move around. And already with the first guess here, we have a strategy which doesn't look that bad. So it's quite interesting, but let me check whether I can live with the rest here as well. And the answer is yes, because formally still there's trades on what was formerly Brent is now Dow Jones. It's now the constant 1, but all the trade results are 0, so don't care about those numbers here. And it doesn't look that bad. So we can even go down with our risk, because you see here lot numbers of 71. So then we might change it by 1 decade down. So still the equity line is absolutely the same. Let's look into our floating results. There we have still something which we have to consider quite carefully, because we have floating results of in the range of $2,500 to the minus. And we have a total win of $8,000. So it's a huge amount we have here. But now we can think, hey, what if you would really have a stop loss in all our trades? So that is something we can look here, because now we have a single trade, and a single trade should have a stop loss. And maybe we get rid of a few spikes in our equity here just by having a real stop loss in our calculation. Maybe it will improve, maybe not. Let's see. And I even don't know. But the good thing is we have a new kind of strategy based on the concept what originally has been the pair trading concept is now transformed to a mean reversion strategy, and that only by having no pair, so no second underlying. And I've done this simply by entering a 1 for all the numbers of the second part of the pair, and that's all. And now we can change once again here EMA values and look what the strategy is doing, whether it's going better or worse, and now it's getting worse. So the number was not that bad already, the 16 here. Let's half it to 8, and you see, oh, not that bad. So it might be a good idea to have here some other numbers, but you see already going from EMA from 8 to EMA 16 doesn't have that huge impact on the equity line. And that's always an extremely good sign for the kind of strategy that even a factor of 2 in an EMA value does not change that much. So it looks quite promising what we have here. Let me change the multiplier in both directions a little bit. And okay, now it's getting worse. But so we have different results. And I get a comment right now here. Yes, there is always much bigger impact, for example, here on the drawdown. Let me redo it, what somebody of you have observed here already. Going from EMA value 8, and you just look to the picture here, and change it back to 16, then you see only by looking to the chart that the drawdown of the strategy changes much more. So that needs additional considerations, as always with those kind of strategies. So 2 steps to be done. One is judge the result of the strategy really by all numbers. So that means take the maximum drawdown into account. And the other thing is, hey, why not introducing a stop loss here and look whether that helps the strategy additionally. But anyhow, we have done a huge step forward. So we know the pair trading concept, and by the way, I can only repeat it, and I can invite you to use that kind of concept for other underlyings or maybe pairs of stock values, maybe stock values which you know are correlated, maybe 2 examples of car industry, let's stay in Germany, like BMW and Daimler. That would be a nice idea as well for looking for pair trades and pair trading concepts, or other thing like maybe you look for gold and silver, and it might work there. So that's an interesting question still. So it's a very good basic concept. And now we have a next step, and the next step is we have that kind of mean reversion strategy going back to the mean. That is the basic assumption of that kind of strategy. Whenever we have an extraordinary deviation from the mean, then trade back to the mean. That's the story we have right now here. So anyhow, it looks quite promising, I can tell you, because we have only 2 parameters here, and the 2 parameter strategy is always extremely interesting because those might be and will be quite robust, which is always good. So oh, the 1 hour is already over, so thank you for being here once again after a short pause in the webinar series, and we will continue on a weekly basis now once again. If you have any questions, no problem, just send me an email. And maybe you keep in mind that there is an additional webinar series really looking for the true basics of trading, one in German, one in English, and you can register here on the link I have sent you already here during the webinar, or you will find it on Argus.fx, and there you find it simply under the button Research Education, and then you go to Webinars, and then you are directly at the same page here, and you can register for those webinars as well. There are no costs, so it's free for everybody, and hopefully I can see you there as well. But anyhow, I can see you maybe back in 1 week. So that's for now. Have a good time and enjoy the day. Bye-bye. Thanks. Bye.